Yeah, very good afternoon. I'm starting the session. So in the last class continuation, actually we have a class at on 12th. Due to the festival, the Pongal, that class was suspended. I'm continuing that class. So earlier we have discussed about that unit 4 and 5 under the Indian financial markets. That is first one is capital markets and second one money market. These two concepts were discussed in the last class. Now we are going to uh, discussing that sixth foreign exchange and derivatives market and also commodities market. What is foreign exchange and what is derivatives market and how that commodities are there. Yeah, foreign exchange and derivatives market. Now, what is foreign exchange and derivatives market? So in this financial markets system, now we are going discussing about that what is the foreign exchange markets and derivatives market. The foreign exchange market, forex market and the derivatives markets play a crucial roles in the global financial system, and it facilitates international trade, investment, and risk management. If any investor want to invest money or want to do business, this financial system will help facilitate any international trade to the investors, because the investors want to invest not only in the domestic level, they also show the interest to invest money in the foreign companies or foreign industries. So, and how that risk is going to be there, how much risk could be there when you're going to investing money in the foreign markets. So here the forex is going to uh, explain about that what is the derivatives and what is the foreign exchange and how these facilitates in the international trade. Now, foreign exchange market. The foreign exchange market or forex or FX market is a global marketplace where currencies are brought. So, for example, in India, we have BS and NSE. So, in this country, only the Indian currency is going to be placing, and different parties are going to be there in the Indian people's only, or Indian investors only. But when you see about this look in foreign exchange market, it's a complete global market, global concept. So in the global, any market, any country, people can participate, and with different currencies. So Indian currency is different, China currency is different, like that. Country to country currencies is going to be different. So all these countries are, countries are going to participating in this forex market. So here they are going to bringing and sold and also exchanged at a current or determined prices. So what is the exact price of the particular share? So they are going to bringing and they are going to selling in the market. They are going to selling in a foreign market means, they, for example, Indian company is there, they want to sell their shares in the foreign currency, forex market. So in this forex market, we are inviting that FDIs, foreign direct investments. So we can also sold that. For example, if any shares are there, we can also, for example, we are purchasing in India, America, or some other UK, Japan, Germany countries. So we are going to selling it in the forex market. So here exchange is going to be there between the countries to country, and also when they're going to purchasing or selling at current price. For example, what is the today share value, and how much price want to sell in the future. That is a determined prices. For example, you purchased in the um, one share is 100 rupees in the 2 years back. Now you want to sell at present there is no that much value. So you are determining that you want to sell that product price share in the of prescribed or particular price. For example, you want to sell it at 200 rupees or 300 rupees in the market. So that is a predetermined determined prices. So in this forex market, they are going to bringing and selling and exchanging at current price and also in the determined prices. It is one of the largest and most liquid financial market in the world, operating 24 hours a day, 5 days a week. So generally, Saturday, Sunday are the holidays. The remaining 5 working days are going to be there. By 24 hours, that market, forex market will be run. So it is the largest and the most liquid. So immediately you can encash that whatever the shares you are going to selling in the market, you can get it into your account immediately. So the liquid financial markets in the world. Now, what are the key features of this forex market? So here, the what are key features? Nothing but it's a global centralized market. So the forex market is a decentralized, meaning it has no central physical location. So, for example, in India, BSC has a one particular location at Bombay, NSC is located at Delhi. So we have one particular place, but it's a complete virtual, or else there is no physical location. So transactions are conducted over the counter, OTC. That is known as over the OTC, over the counter. So if they want to sell at a particular price, they are going to selling it in the over the counter. So currencies are as a primary asset. Yes, definitely. Here the currencies, because country to country currency is different. For example, we are going to exchanging one value, 1 rupee with US dollar. We have to pay about 85 rupees or something. So here the currency is important. So that currency is also different to differ to country. So the market deals with the trading of currency pairs like euro and USD, United States dollar, that is known as fiber. So here that is the important aspect when you're going to exchanging with the euro or USD, that is known as fiber, or else GPP. So Great Britain pound, that is London, no, Britain. So USD, United States of dollar, that is a cable, that is known as a cable. So when these two countries are going to exchanging, that is in a cable, or else USD and American dollar along with the Japanese yen, JPY. Japanese yen is known as a copper. So copper or fiber or cable, it's a name for a particular country's transactions. So when there is a two countries are going to be trading, there is a name for particular um, uh, currency is going to be exchanging between the countries, or else when you are going to trading with these countries also, that is a fiber or cable or copper. So this is the currencies is a primary asset in the key features in the forex market. Now, who are the participants here? So in the forex market, central banks, commercial banks, corporations, retail traders, and speculators are going to participate in these banks. So central banks influence currency values through monetary policy and interventions. So these central banks, for example, RBI is the central bank of our India. Like that, country to country central bank is different. So that influence the currency values through monetary policy. So and interventions. So they are going to deciding that the value of the particular country's price. So when they are going to exchanging the money, so they must have a monetary policy. So policy is going to be implemented or constituted by the central bank like RBS in RBI is for Indian. So the country to country is different. The central banks will change the monetary policies accordingly. And the commercial banks and financial institutions. So it facilitates bulk currency transactions. So commercial banks here, for example, ICICI Bank, SBI, or else HSBC, even foreign banks also operating in India, like Bank of America and HSBC or some other countries. It facilitates the bulk currency transactions in the financial institutions because the commercial banks also play a vital role in the foreign forex market. And also corporations engage in forex for international trade and hedging risk. So corporations, multinational corporations, MNCs, they used to invest money in terms of foreign direct investments or FIS, foreign institutional investments, FIS. They used to engage in the forex market in the international trade and hedging risk. And retail traders. The individual investors also speculate on currency movements for profit. So definitely the country they don't bother about that country, but they are going to purchase in that value when there is good trading. And the speculators, the focus on the short-term gains from price fluctuation. So even like a SEBI also speculators also is going to be there. Here, in the forex also speculators because they used to promote or also they used to uh, do the business for the short-term purpose to gain the profits from the exactly the existing price fluctuation. So what are the major centers in the world, in the globe, that are the forex market? So London, New York, Tokyo, Hong Kong, Singapore, and Sydney are the key hubs for foreign exchange. So if you want to do the trading in the London or New York, Tokyo, Japan, Hong Kong, China, Singapore, Sydney, and America, and Britain. So these are the trading centers, major trading centers in the world. So these are the hubs. So you can go here and do the purchase or sell or exchange the currencies values in these trading centers. And high liquidity. The trillions of dollars traded daily, it ensures ease of transactions without significant price changes. Without any changing of the price, they used to change the trillions of dollars traded in the daily basis, and also high liquidity is going to be there in the forex market. The currency pairs, the major pairs like it includes the USD and widely traded currencies, example UR and USD. So these are the major pairs because any country used to do the business with the Europe countries like Russia on countries along with American, that is USD. So United States of dollar and euro are the major pairs um, in the world because the people are going to investing and also looking about these two countries especially in terms of investments. So minor pairs also is there like excluding USD, but include major currencies. Example, UR GBP. Except USD, the remaining all countries comes under the minor pairs like Euro and a Great Britain pound and some other uh, countries. There are minor pairs in the currency, pairs in the market, and exotic pairs also is there. It involves a major currency and a less traded one. So generally, they don't much do the business operations. Which the less trading is going to be there. The currency pairs, that is USD and TRY. So here there's two countries, very exotic pairs, less traded is going to be there in the um, business. And floating versus fixed exchange rates. What is floating and fixed exchange rates? Is a floating rates not determined by market demand and supply. So it depends upon the market demand and the supply. The floating rates is going to be changing. So they have to determine the market demand depends upon the market conditions only we are going to selling or supply. And fixed rates are pegged to another currency or a basket of currency. Currency are going to be placed because this is fixed. There is no change of the particular currency rate because they don't want to take any kind of risk. That is the reason they are going to fixing particular prices in the countries. And what is the importance of the forex market or foreign exchange market? So it facilitates foreign exchange, facilitates international trade and investment. So this foreign exchange, it facilitates the international trade, not globally, so not domestically. So for this international trade and investment. So any investor, they can purchase, they can sell, they can invest money in the given minor, major or exotic states. So in that countries only, they are going to investing money because they know the value, currency values in the market and how much and what extent that is going to be increasing or getting value. So depends upon that, the persons are going to, uh, um, you know, facilitate. So, uh, and um, international foreign trade and investment. So it enables the currency conversion for cross-border transfer. So one-to-one countries transaction is going to be exchanging that values and supports monetary policy. So monetary policy, uh, definitely that foreign market, forex market is going to be um, as it supports the monetary policy because there are a number of countries are going to participating in the foreign forex market. So the reason monetary policy is going to support, like central banks use forex operations to stabilize or influence their currencies. So it depends upon the movement. They are going to changing the currency values or that movement stabilize that economy. So that's the reason the government, central banks like RBI, they used to support in the international trade. Hedging against the currency risks. Companies and investors manage exchange rate risk exposure. So currency risk. So companies, all MNC, multinational companies, so they used to uh, exposure the managing the exchange risk rate and the risk and the speculative opportunities and the traders profit from volatility in the currency prices. So the speculative means there is no constant, there is no stabilization. So here the speculative opportunities, traders profit from volatility in the currency prices. And another thing is that risk in forex trading. So here risk also is there in the forex market. When I'm doing with the countries, what are the problems are going to be there? Let's see that for the market volatility, prices can fluctuate rapidly. So country to country, economical conditions are different. So, for example, let's see example in Ukraine and Russia, there is a war is going to be going on now. So here, the market volatility completely, all the things is going to be suddenly increase, or else sometimes demolish all particular things. So that market volatility is also important factor in this country and the leverage risk. So leverage is, but it amplifies the gains, but also losses. It amplifies, that gains the profits, but that they don't have much risk in this field, because investments are going to placing in a leverage, with the leverage only, and the political and economic events. So impact currency values unpredictability. So what is the political and economic events? So based upon that, how much that is going to impacting on the currency value. So they are going to looking about the particular concept, concept also, and liquidity risk. Some currency pairs may be liquid, liquid leading to higher transaction cost. So liquid also high is there. So in terms of value, so they are going to exchanging that uh, they are going to changing the commodities. So the liquidity risk. Some currencies are pairs may be less uh, liquid in the see this for now. So in this higher transactions are going to be there. Now derivatives market. What is the derivative market? A derivative market is a marketplace where the individuals and institutions trade financial instruments. So a derivative market is a financial marketplace where individuals and institutions trade financial instruments called derivatives. So these derivative instruments derive their value from the performance of underlying assets such as stocks, bonds, commodities, currencies, interest rates, or market indices. So the derivatives are the instruments derive the value from the performance underlying the asset, such as stocks. So they're deriving the stock value. The stock is going to be increasing. They're deriving the particular what extent of the stock value has increased. That existing uh, value is going to be there. So the stock is going to be derived. Bond also, the bond price or the interest they are going to deriving, and commodities also, the when the price is going to be increased, the share value is going to increase, they're deriving. And the currencies also, sometimes when the value is going to be increased or decreased, depends upon the currency values. So interest rates also depends upon the country to country interest rates, that also will be derived in this derivatives market or market indices. So market is going to be fluctuating or not, whether how that uh, business is going to be um, developing in that country. So these instruments derive their value from the performance of underlying assets such as stocks and bonds. Now, what are the types of derivatives? So let's see the types of the derivatives. The futures, options, swaps, forwards. What are the futures? The agreements to buy or sell an asset at a predetermined price on a specific future date. So if you want to sell or buy a particular asset in the future date, so that you are going to predetermine the price. For example, if you want uh, purchase one particular say share at 100 rupees, so you are going to, at present, if you are not going to getting that value, you are going to fixing that price. Certainly, there is a agreement that you are going to selling or purchasing on particular date of the future. The same way selling or else buying, the both conditions. So, two-way, that is a agreement between the parties. They are going to, if they want to sell, they have to sell at the same price in the future. If you are, for example, I want to sell one particular asset today, so I am asking that I am at present I am selling my shares because of an urgency or some other factors, but certainly I will purchase these shares in the future with the same or some other fixed common fixed price. So there is an agreement is going to form between the two parties. The two parties are going to come into the agreement. If they want to sell or purchase, they must sell and settle at the particular price. And options, the contracts giving the holders the right but not the obligation. So to buy or sell and set at a predetermined price before on a specific date. Otherwise, when they're into agreement, it's not possible to purchase or sell the property. So the person is going to, when he is going to purchasing the property, definitely they are going to looking about that futuristic dates, or else they must complete that transactions. That means, what are the asset selling or purchasing, buying, swaps, contracts to exchange cash flows or financial instruments between parties, commonly used for interest rates or currencies. So swaps contracts also exchanging the cash flows or financial instruments between parties, commonly used for interest rates or currencies. So see, these swaps are going to be using as a contract of exchanging cash flows or the financial instruments between parties, commonly used for interest rates or currencies. And also forwards, customized contract between two parties to uh, buy or sell asset at a price on the future date. For example, if you want to purchase a particular degree certificate, so uh, they must have a particular common interest. So the swaps are the forward markets are the customized contracts between two parties to buy or sell an asset at a set price on the future date. So when they want to purchase or sell, they must customize the contracts between the parties. Otherwise, that party maybe that party uh, may be used in the different parameters. Now, what are the participants in the derivatives market? Now here, hedgers, speculators, and arbitrators. Here, the speculators also is there in the futures market. But then see here, hedgers use derivatives to produce or manage the risk associated with so it's structures of an underlying asset. And speculators. It is aimed to profit from price movements of derivatives. So speculators aims to give a profit from the price movements of a derivatives. So they used to participate in terms of profit angle only. So they used to always how to gain the profit from the derivatives. Arbitrages. It exploits the price differences between market to earn risk-free profits. So they exploit the price differences between the markets to earn um, risk-free profits. And what is the purpose of the derivative market? The risk management, price discovery, and liquidity leverage. So risk management provides a way to hedge against the potential losses due to fluctuations in prices or rates. So risk management will help help out in the this segment. So price discovery. So helps determine the future prices of assets through trading activities and liquidity also. Uh, it offers a platform for buyers and sellers to trade quickly and efficiently. So liquidity always a purpose because if you are going to selling in the financial market or financial assets, if you are going to purchasing any financial assets, definitely they have to provide the possibility to or else run their family with that particular location. So that liquidity offers this platform for buyers and sellers to trade quickly and uh, and efficiently. And also leverage. It allows the participants to gain large exposure to assets with a relatively small initial investment. So here the leverage. So it allows the participants to gain um, large exposure of asset, like large size of exposure to asset with a relatively small initial investment. What are the major derivatives market? CME Group, Eurex, and NSE. So in the world, about three are the major derivative markets. That is CME Group. It's a leading global derivatives marketplace, and Eurex, Europe's largest derivatives exchange. These are the major derivatives of the market, and National Stock Exchange of India, NSE. So it hosts an active derivative segment, including futures and options on indices and stock. So, so National Stock Exchange of India, NSE, HOTS, and derivative there is segment including futures in the uh, and options on indicating trade. Now, what are the risks associated with the derivatives? So there are four types of risk are going to be associated with that derivatives. That is market risk. Market risk, it is price volatility in the underlying asset. So market conditions are fluctuates depends upon the asset. The price volatility is going to be changed. There is no constant or stabilized market in this angle. So market is going to be there in the derivatives market, and also counterparty risk. Counterparty risk also the risk that one party may default on their contractual obligations and also liquidity risk. Liquidity risk is difficulty in buying or selling the derivatives without impacting its prices. So the liquidity risk also is difficulty in buying or selling because the derivatives without impacting its prices. That is not going to be impacting on the price. So definitely the risk also liquidity is also to be there, and also operational risk. and it errors in the executing or managing derivatives contracts. So operational risk also is going to be there. This is also one of the risks associated with the derivatives. Now another unit is that the commodities market. What is the commodity market? Let's see here. Commodities market is a marketplace where the raw material or the primary products are traded. So the commodities market, uh, the raw materials and the primary products are going to be trading. So these materials are categorized broadly into hard commodities, that is the natural resources like gold, oil, and metals. And soft commodities also there is agriculture products like wheat, coffee, and cotton. So this soft commodities also is going to be there in the commodities market. So commodities markets allow producers, traders, and investors to buy or sell the hedge physical and the derivative commodity contracts. So commodities market allow producers, those who are going to producing that soft commodities like agriculture products like wheat, coffee, and cotton, some other, and also selling the same way. How they are going to selling, who are going to selling that particular this commodities market, the hedge physical and derivative commodities are contract. And the key features of the commodities market. What are the key features? Here, the standardized contract, global name, derivatives trading. So, standardized contract commodities where are traded through standardized contracts and the specific quantity, quality, and the delivery terms. So, this is about the standardized contracts. So, contracts are are going to be there. So definitely that commodities are traded through standardized contracts, specifying the quantity, quality, and delivery terms. So these are the parameters to consider in the standardized contracts in the commodities market. And the global nature, the prices and are influenced by global supply and demand, geopolitical factors, and weather conditions. So, in the global nature, these are the problems are going to be there because the price is going to sometimes price is going to be increased. So that is the price are influenced by the global supply and demand. So here the geopolitical factors and weather conditions are nominal, that may not important factors, but in a global level, uh, political factors and the weather conditions also the factors in the commodities market. And derivatives trading. Commodities can be traded directly, that is a spot market, or indirectly through futures, options, and ETSs. So derivatives are going to be trading in a two-way. That is on a direct market, a spot market, or else if not possible, indirectly. Indirectly also, they are going to doing the trading in the commodities market, that is the futures, options, and ETS. And what are the types of commodities? So here the see some types of commodities. What is the hard commodities? It is extracted or mined. What is that hard commodities? It's energy. It includes crude oil, natural gas, coal, and electricity. These are the hard commodities. So these are going to be extracted from the mines or from the land. So here the example is the crude oil, and Brent and WTI are the benchmark crude oil traded globally. So in India, for example, we are importing petroleum products from the Saudi Arabia countries or Iran or some other countries because we don't get that crude oil. So that's the reason we are going to getting that Brent and WTI are the benchmark of crude oils is good trading in the globally. So So it's all these are the extracted or extracted commodities. And the metals, the previous metals, gold, silver, platinum, and industrial metals, copper, aluminum, zinc. So precious is nothing but all we human are going to using the gold, silver, platinum. But in the industrial metals, copper, aluminum, and zinc. So example, gold features used as a hedge against inflation and currency um, uh, inflation and the currency are going to be uh, uh, are going to be um, currency are going to be changing these metals, like metals and the hard commodities. Now, soft commodities. So, agriculture and livestock products are the comes under the stock commodities. And another thing is that here uh, soft commodities are divided as agriculture products and environmental. What are the agriculture products? Grains, wheat, corn, soya beans are the examples of agriculture products, and also livestock. The cattle, hogs are the livestock, and softs also coffee, cocoa, sugar are the uh, soft products of the you know these no uh, the sofa soft coffee and the cover. So all these are the agriculture products categories. And also example, wheat features farmers hedges against uh, against price drops, buyers hedges against price spikes. Mm. So farmers hedge against the price drops, buyers he hedge against the uh, price spikes. So environmental and for environmental, there is a carbon credits, renewable energy, and certifications. So these are the major points of the these so carbon credits. What are the examples of commodities market? So here the CBOT, NYMX, LME, MCX, Chicago Board of Trade, CBOT. Here the traders trades the commodities like corn, wheat, and soybeans are going to be traded in the Chicago Board of Trade, and the New York Board of Commodity. So New York Mercantile Exchange. Uh, so that NY emits also, there is a new arc. The name name indicates the importance of the particular said. So the New York Merchant Exchange and London Metal Exchange. So London Metal Exchange is nothing but LME. So the London Metal Exchange also deals with the deals in base and industrial metals. What are the industrial metals are required to the industries? These LME is deals that particular products to the LMEs, that is the light motor vehicles. And multi commodity exchange MCX, multi commodity exchange India MCX. It trades a gold, silver, crude oil, and agriculture commodities. So here these are the commodities are going to be placing are going to be getting uh, so multi-commodity exchange MCX deals with the traders in sell crude oil and now what are the benefits of the commodities market? Here, hedging, speculation, and diversification. Now, the benefit from the hedging is that farmers, producers, and business can manage risk related to the profit fluctuations. So, depends upon the foreign. So, hedging nothing but farmers, producers, and business can manage risk related to the profit fluctuations. So, example, a farmer looks in the price of whether and speculation. Here, the example is that a farmer locks in the price of weather before harvesting using. Uh, so, the speculator seeks to profit from price changes. So, they used to see always a depends upon the importing. So, how much, how fund they are importing the um, particular property. So, so a spectator buy, sell, or future expecting. So buying, selling of the and diversification. It provides an alternative investment to stocks and bonds, often uh, inversely correlated with the traditional financial markets. So diversification means they are going to diversifying the funds from one party to another party or one investment to another investment. It provides an alternative investment to stocks and bonds, often inversely correlated with the traditional and financial market. The key commodities market segment. Here, the key commodity markets segments are the spot market and futures market. The spot market, physical trading of commodities, where delivery happens immediately or shortly after the trade. Though in the spot market, the physical tradings of the commodities where sometimes it may be happen immediately, or else sometimes it may be a delay. So sometimes it may be happen by because physical trading of the commodities are going to be there. It delivers the immediately, or it takes some short time after the trade. But in the future market, trading standardized contracts to buy or sell commodity at a predetermined price on a future date. So they are going to fixing, for example, we are in the 2025. They are going to fixing particular date in the 26, maybe January or February, within 1 year. For example, they're going to fixing 1 year or 6 months time. When they are going to selling or else buying particular shares, they are going to predetermining the future date. That is the future market. Now, what are the changes of the major commodity exchanges? So in the global exchanges, Chicago Mercantile Exchange (CME), London Metal Exchange (LME), and ICE Intercontinental Exchange (ICE). So these are the global changes. Chicago Mercantile Exchange is one of the largest global platform for commodity derivatives. So when they are going to do the commodities business, commodity derivatives in this global platform, so Chicago Mercantile Exchange is one of the largest platform. And also London Metal Exchange also is there. There is a specialized in metal tradings. So when there is a metals, the London Metal Exchange is a specialized global exchange under the commodities market or commodities exchanges. And Intercontinental Exchange, a major platform for energy and agriculture commodities. If any agricultural commodities or energy for platform purpose, this intercontinental exchange is going to be involving, and that is going to be placing in the global market and Indian exchange markets. In the Indian exchange markets, in a multi-commodity exchange, MCX, this is the largest commodity uh, the largest commodity exchange in India, dealing with energy, metals, and agriculture products. So in this MCX, this is going to be dealing that what are the metals, agriculture products, and energy. So here, almost important commodities are going to place in this MCX. So in the national commodity NCDX, National Commodity and Derivatives Exchange also is there in India. It focuses on agriculture commodities like soybean, guar gum, and spices are the important things in the NCDX. So all these MCX and NCDX are the Indian exchanges. So in these exchanges, all energy, metals, agriculture products, and soybean, guar gum, and spices are going to be uh, exchanging or else trading in the commodities market. Now, participants in the commodities markets. Who are the participants? The producers, consumers, speculators, and arbitrageurs. So producers use the market to lock in prices for their products. So producers always they used to use the market to lock the prices for their products because they are the producers. So they have right to lock the prices. And consumers always they hedge against the price fluctuations in the raw materials they need. So the customers, what they need, they used to bargain or negotiate the fluctuates the price fluctuations are going to be they used to observe and they used to do the trading and the speculators that the trade to profit from price movements without necessarily delivering or receiving the actual commodity. The speculators, the duty is that they used to always focus on the profit angle only the price movements without necessarily delivering or receiving the actual commodity. But always they used to think or look about the profit angle only. And arbitrators also exploit the price differences across markets and exchanges. So they used to exploit the price differences in the markets. So why trade in commodities? Actually, this is the important factor. Actually, why we have to do trade the commodities. So the because portfolio diversification and hedging against inflation, leverage opportunities. The portfolio diversification commodities often have a low correlation with other asset classes like stocks and bonds because actually stocks and bonds are different portfolios. So we don't correlate with each other. And also hedging against the inflations. The prices of commodities like gold, crude oil often rise during the inflations. So sometimes, for example, in the Ukraine and Russia war, the crude oil are going to be increased. Like gold also increased, depends upon the situation at times. and leverage opportunities. The futures and options in the commodities allow trading with a relatively small initial margin. So these small initial margins, the leverage options are going to be there in the futures and options for commodities. Now, what are the risks are there in the commodities trading? The price volatility, leverage risk, supply chain disruptions. So what is the price volatility here that influenced by the supply demand imbalances, geopolitical tensions, weather, and economic data? Like example, oil prices, sugar during geopolitical tensions in the Middle East countries. In the Middle East countries, there is a war or disputes are going to be there on the oil prices and sugar. And leverage risk. The futures trading involves significant leverage, amplifying both gains and losses. So what are the profits or losses are there? If you are trading, it will also significant leverage and the supply chain disruptions. So natural disasters or global crisis can disrupt supply chain and impact prices. So these natural disasters are going to be are the global crisis are the disruption in the supply chain of the impact of the commodity trading and the geopolitical risks. Many commodities like oil are sensitive to political instability and storage and transportation and regulatory risks. The storage and transportation is a physical commodities involve cost for storage and logistics. It's because gold or some other cotton, soybean, we have to store. This is also one of the risky associated with this thing. And many commodities like oil are sensitive to political instability. Yes, definitely. For example, we also, as the Indian, we are importing that of the sunflower oil from the Ukraine because we are going to be importing the seeds from there only. There's a sensitive issue in the political factors and also regulatory risk also is good. The changes in the trading rules or government policies can impact the markets. Definitely, regulatory risk are going to be there from country to country that may be vary and time to time that is going to be changed by the governments. And the last point is that um, now real world example. So gold as a commodity. So spot market, immediate purchase of the gold for physical delivery. This is also one of the example. And gold futures, a contract to buy or sell gold at a predetermined prices on a future date. And also use case. Investors buy gold as a safe haven asset during economic uncertainty. So in the spot market or gold or the use cases, the gold as a commodity. So this is a real example in the derivatives market because the contract also is going to be there in the future. There is a two types, contracts are going to be there is a buying and selling of the gold at a predetermined price and the future dates. So, so in the tomorrow class, we are going to discussing about the financial services, one that is the banking services, insurance services, and financial inclusion. So this part will be discussed in the tomorrow's class. So with this, I'm signing out. Thank you.